Most investors spend years trying to beat the market, picking stocks, timing trades, and constantly reacting to financial news. Yet the majority still underperform over the long run. Ironically, one of the simplest investing strategies often produces better results than the complicated approaches most people chase. By giving investors broad diversification, lower fees, and long-term exposure to entire markets or sectors, ETFs have quietly become one of the most powerful tools for building wealth consistently over time. Today we will talk about the ETF strategy that beats most investors, so before we get started, make sure to hit that like button, also subscribe to my channel. 10. Most investors make investing far more complicated than it needs to be. When people first enter the stock market, they often believe successful investing requires constant research, advanced analysis, and perfect timing. They spend hours searching for hidden opportunities, watching market news, and trying to predict which stocks will explode next. But ironically, many professional studies and long-term market data show something surprising. Most active investors fail to consistently outperform simple long-term index investing strategies. This is why ETFs, exchange-traded funds, became so powerful. Instead of trying to pick individual winners constantly, ETFs allow investors to buy entire groups of companies at once. And while this approach sounds less exciting than chasing the next hot stock, it quietly outperforms many emotional, inconsistent investors over long periods of time. The strategy sounds simple. The hard part is following it consistently. 9. ETFs remove the pressure of picking the perfect stock. One of the biggest problems investors face is stock selection anxiety. Every decision feels high pressure. What if you choose the wrong company? What if the stock crashes? What if you miss the next major winner? ETFs solve much of this problem by spreading investments across many companies simultaneously. Instead of depending entirely on one business succeeding, investors gain exposure to broader sectors, industries, or even entire economies. This diversification dramatically reduces the damage one bad decision can cause. It also lowers emotional stress because investors stop relying on perfect predictions to succeed. 8. The strategy works because markets tend to grow long-term. The core idea behind long-term ETF investing is surprisingly straightforward. Economies grow over time, businesses innovate, populations expand, and productivity improves. While markets experience crashes and volatility short-term, broad markets historically trended upward over long periods. ETFs allow investors to participate in that overall growth without constantly trying to outsmart the market itself. 7. Consistency matters more than intelligence. One reason ETF strategies outperform many investors is because investing success depends more on consistency than brilliance. Many people invest emotionally. They buy during excitement, panic during crashes, stop investing during fear, and constantly change strategies. ETF investing works best when automated and repeated consistently over long periods regardless of market conditions. This removes one of the biggest dangers in investing: human psychology. Instead of trying to predict every market move, investors focus on staying invested long enough for compounding to work. 6. Dollar cost averaging quietly reduces emotional mistakes. One of the most powerful ETF strategies is simple dollar cost averaging. Investors contribute fixed amounts regularly, regardless of whether markets are rising or falling. When markets decline, contributions buy more shares. When markets rise, investments continue compounding inside growing assets. Over time, this smooths out emotional decision-making and reduces the pressure of market timing. Most investors struggle with this because emotionally, people want certainty before investing. But markets rarely feel emotionally comfortable during the best long-term buying opportunities. 5. Fees quietly destroy more wealth than people realize. Another reason ETFs outperform many active strategies is cost efficiency. High management fees, trading costs, and excessive buying and selling quietly reduce long-term returns. Many ETFs have extremely low fees compared to actively managed funds. Over decades, even small fee differences compound into surprisingly large amounts of money. This is one reason long-term investors often focus obsessively on costs. Preserving returns becomes just as important as generating them. 4. ETFs turn investing into a system instead of an emotional event. Most people treat investing like a series of emotional decisions. They react to news, social media, market crashes, political events, and economic fear constantly. ETF investing changes the process completely. It transforms investing into a long-term system rather than a short-term emotional reaction. The investor no longer needs to predict every market movement. The focus becomes staying disciplined, diversified, and patient over years or decades. This simplicity is exactly why the strategy works so well for ordinary investors. 3. Diversification protects investors from their own overconfidence. Many investors secretly believe they can outperform the market consistently. Sometimes they succeed temporarily, which increases confidence further. But long-term markets are extremely difficult to predict reliably. ETFs acknowledge uncertainty directly. Instead of betting heavily on a few individual outcomes, they spread exposure broadly across many businesses and sectors. This protects investors not only from market risk, but from their own emotional overconfidence, a risk many people underestimate completely. 2. The real advantage is psychological stability. The greatest strength of ETF investing may actually be psychological. Because the strategy is simpler, diversified, and long-term focused, investors often experience less stress and fewer emotional swings. This matters because emotional mistakes destroy enormous amounts of wealth. Panic selling during crashes, chasing hype during bubbles, and constantly switching strategies are behaviors that quietly damage long-term returns. ETF investors who remain disciplined through volatility often outperform more emotional investors simply because they stay consistent longer. 1. The ETF strategy that beats most investors. Simple, diversified, long-term consistency. The deeper truth about investing is that extraordinary complexity is often unnecessary for building long-term wealth. The strategy that beats many investors is surprisingly simple. Buy diversified ETFs consistently, keep fees low, stay invested long-term, and avoid emotional decision-making. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.